Okay, so the main idea behind our whole theory for the market structure basically is that what really happens is usually you look for a price to print in a high, higher high, and high lows. What usually happens is when you're trying to trade based on that, the biggest problem comes in when you try to place your stop probably here, price runs them through and then keeps pushing higher. Now, this is the major trap that occurs like always. Whenever you see expansion, you will see a price taking out any sort of intermediate short-term high or a short-term low before expansion. Every single day, same case applies here. Now, if I were to see this chart too on SPX, I can see that price run through the previous low first, chopped here before expanding high. This is not like the ideal PA, but this delivers the point. We have multiple examples every single day on this. We swept this low or probably formed a SMT divergence at the lows before running higher, or you can say expansion is always followed by a raid on a high or low. That is our main idea of the whole process. Now, the key thing here is your time frame alignment. Let's say this is your 15-minute chart here. You see a raid on a short-term low, which you will probably get stopped if you have a long position placed something like this with your stops at this low. Now, if you have a time frame aligned, let's say on R4 time frame, what will happen is you will see only this leg, and you will see the expansion just after price tags inside a high time frame area of interest or rating on a low time frame. Now, probably we would have had a 4-hour fair value gap in this case at this level. I'm just taking example. What really happened is 15 minutes shifted its structure here, convincing you to short this retest. While if you check the 4-hour time frame, this was just a pullback inside the 4-hour gap before price expanded high. We have multiple examples day in and out on this on every single asset class. Let's do some examples. Now here, this is the 4-hour chart. We formed a fair value gap here. This is the 4-hour. On 15-minute, you will probably see price breaking below like this, trapping you here before pushing to the upside. Now let's go to the 15-minute chart from 4-hour. Here it was just a raid, right? On the more low time frames, you probably would have a closure below, convincing you to short this move, and eventually price will start expanding after the manipulation has been done. Here again, the 15-minute gets raided before price starts to push higher every single day, every single time. Yes, here on the 5-minute, we had broken down the structure. We have the candle closures below, convincing you that market is bearish and you should short this retest. But what happened is price instantly reversed, changing the state of delivery or the market structure here, and then eventually pushing higher. We had multiple rates on the way to. Now, if you want to see the ideal PA, like the perfect scenario of the market is when price is going in your direction. Let's say you're expecting prices to push to a certain level. In this case, let's take this high. This is your target. This can be any swing high or one thing you want to keep in your mind is you want to see PA develop like this. Let's say price taps the zone and rejects all. Now, when price is coming down, you should need to see failure swings. Now, failure swings basically are when price doesn't takes out any of the high or low when pushing down. You want to see price respecting every high, every high, every high here, generating the liquidity all the way till we tap our high time frame PDA day. In this case, let's take this as the example. We want to see price rating these highs, lows to see the expansion when price pushes to our direction. But on the opposing side, where price is coming from, you need to see some sort of failure swings where price is unable to take out the previous highs, giving you a good liquidity points to target. And let's say we tap this zone, you need to see price pushing higher, raiding this low again for the early buyers to get out of the market, then shifting the structure, forming a low, raiding that, expanding higher, and always price does this, and finally approaching your target. On the opposing side, you do not want to see any short-term high to be rated like this before pushing down. You need to see failure swings, lower highs, lower highs, lower highs, generating all the way liquidity up. So when price starts to push from here, you can see it knife it through like butter. So that is the main idea of our concept. Instead, watching for market structure shift on this side, you expect these rates inside a PD array. That would be a fair value gap. That would be an order block or anything, right? And then eventually continuing higher. So what we are trading, we are not going to trade this job. We will wait, ideally have our limits or wait for price to tap this zone. Now, let's say this is a 15-minute chart and we are trading this leg. Probably we have New York open time here. So I expect price to push through this time only. I'm just taking an example. Let's say we have this as a New York kill zone, New York open. What we want to see on the low time frame would be that price to form set of equal lows. I'm extending this. Count this right time frame as M1. What we want to see here now is, let's say we pushed higher. We want to see price raiding them through, giving us a market structure shift, forming a short-term low to the right, expanding higher, short-term low, raid that, and that is your trigger to long. Wait, I will adjust, please. Right, like this. We want to see price having multiple raids on our side when we start to push higher, giving us a structure like this. And where are you going to take your position in this case? You will be longing the raid here on the short term. That is your trigger long. Once we flip this high, market long it, your stops would be under the intermediate term low formed, targeting maybe a fixed 2 hour or targeting the opposing buy side liquidity or previous highs and lows. So let's say this is your 4 hour time frame. This is a 4 hour gap. And on the 4 hour, our structure looks something like this. We formed a high here. We tapped this 4 hour gap and now expanding high. Now, if I'm aligning all my time frames, I can say that this is a plus setup, giving me the 4 hour for the bias and the direction of the market, giving me a high time frame level, M15 buy model and this raid as my trigger, and then M1 for my entry, catching this move only the expansion. No need to get stuck throughout this whole chop. Just wait for price to tap a level and lower your time frame, find the change in state of delivery or any market structure shift, and then jump upon as we flip the short term, the high of the short term low formed. Rate that short term low, intermediate term forms, and get in once this high gets reached.